Microsoft and Apple are amongst the big five tech firms which make up almost 25% of the S&P 500 index. Their share prices have increased by 43% and 52% respectively over the past 12 months. Is this growth sustainable, and is the price overvalued? Well, in this second video of a three-part series, we'll be completing an analysis of the big five tech stocks to evaluate whether it's still wise to invest in these companies. So let's review and compare Microsoft and Apple on today's Investment Store. Welcome to the Investment Store, the personal finance channel that reviews a diverse range of investment asset classes, from stocks and ETFs to real estate and cryptocurrencies. If you enjoy this video, please click the like button and leave a comment. And if you like our content, then please subscribe to the channel to become part of the Investment Store community and hit the notification bell to ensure that you never miss an episode. With that said, let's commence with today's video. In our last video, we completed a review of Amazon and Alphabet. If you haven't watched that video yet, we left a link to it below, and we strongly suggest that you watch that first. Towards the end of this video, we will do a comparison between all four stocks: Microsoft, Apple, Google, and Amazon. And in the last of the series, we will complete a review of Facebook and compare them with some of the rising companies in the tech space. Now, with that said, let's proceed with the analysis. At the Investment Store, we take a four-step approach to analysing stocks. First, we consider Economic Moat, where we analyse whether a company has any form of competitive advantage. Second, we look at the fundamentals and assess the organisation's financials by looking at their financial statements and key ratios. Third, we then compare the stock with other companies and investment funds in the sector to assess how they're performing in their market. And finally, we calculate the intrinsic value of the stock to see whether it's trading below its fair value. Once we've completed our four-step approach, we will aggregate these scores to generate the Investment Store score. Now, with that said, let's start with today's analysis. So let's first consider the intangible strength of both companies. Looking at Microsoft first, since Satya Nadella was appointed CEO of Microsoft in 2014, he has successfully transformed the company into a solution provider rather than just a software firm. He has also made some very clever acquisitions of companies that have added depth and diversity to the brand. Most of Microsoft's products and services have a significant market advantage, so we score Microsoft a 10 out of 10 for intangible asset. Apple, as we all know, are a premium brand, and their competitive advantage stems from their ability to master both hardware and software and combine these into creating appealing products and services. No other player in the tech space has mastered both hardware and software like Apple, so for this reason, we also score Apple a 10 out of 10. Let's move on to switching costs or services. Microsoft dominates the Office applications market, and Office 365 is a default package for most organizations across the globe. Switching these products are disruptive and costly to businesses, so we score Microsoft a 10 out of 10 here. Apple has a closed product ecosystem, which gives them control over content and media whilst tying in their customers. This is commonly known as a walled garden approach. Now, although Apple has a strong position in this area, competition in the smartphone sector is increasing annually and could threaten Apple's dominance in the US market. Smartphones make up over 50% of Apple's revenue, so they are exposed here, and for this reason, we score Apple a 7 out of 10 for switching costs. In terms of cost effect, Microsoft's dominance in the professional software application space allows them to charge a premium which is unrivaled. Therefore, we score them a 10 out of 10 for cost effect. Apple's walled garden approach allows them to charge a premium, and its mastery of hardware and software has enabled it to remain ahead of its competitors. Their cost advantage is dependent on their ability to keep innovating. However, we believe they have the capabilities to continue doing this successfully, so we've scored them a 9 out of 10. In terms of network effect, Microsoft acquired LinkedIn in 2016 and is now aiming to add TikTok to its services. We believe the TikTok acquisition will be significant, as it will improve their consumer exposure in the mobile devices sector, which is an area where they're relatively weak. This would also increase advertising revenue and help capture market share from the likes of Facebook and Google. So we score Microsoft a 9 out of 10 here. Apple has a loyal customer base. However, its consumers and app developers tend not to work exclusively on iOS, which makes sense as Android does have a dominant share of the mobile operating systems market. So for this reason, we score Apple an 8 out of 10 for network effect. Finally, in terms of scalability, Microsoft has clear dominance in most of their sectors, and their market share in these areas continues to grow. As mentioned earlier, we believe the TikTok acquisition will expand this further, so we score them a 10 out of 10. Apple are constantly developing and innovating and investing in new products and services. They have also achieved consistent revenue growth through their wearables and entertainment products over the past 3 to 4 years. Therefore, we score them a 9 out of 10 for scalability. This gives Microsoft an overall Economic Moat score of 10 out of 10 and Apple a score of 8 out of 10. Next, let's move on to the fundamental analysis, looking at Microsoft first. Microsoft's operating margin has remained over 20% for the past 10 years, and its net margin has been consistently into the double figures. This is often a clear indication of a wide moat and a competitive advantage in an industry sector. Now, their Q2 margin is down on 2019, but we still believe they're strong in this area, so we've scored them a 9 out of 10. For return on asset, we like to see an ROA greater than 10% for a tech stock. Microsoft have achieved this ROA level in 4 out of the past 5 years, so we've scored them a 9 out of 10 for this. And for return on capital employed, or ROCE, we like to see a ROCE level over 15% for a tech stock, and Microsoft have achieved this in 2 out of the past 5 years, so we've scored this an 8 out of 10. Moving on to debt to equity, we like to see this value below 1, and Microsoft's debt to equity has been above 1 over the past 5 years. This could be a reflection of their investment activity, but it has been as high as 2.13 in the past 5 years, so we've scored this a 5 out of 10. Moving on to PEG ratio. As mentioned in our last video, we like to see the PEG ratio at as low a level as possible. Microsoft's PEG has been below 1 in 3 out of the past 5 years, which means it was trading below fair value during this period. It has since increased to 2.78, so we've given this a score of 7 out of 10. Microsoft's free cash flow yield has been as high as 8% in the past 10 years and 6% in the past 5 years, and this is very impressive. However, it has been decreasing year on year, which is a slight concern. Again, this could probably be down to the investments that they're making in new sectors and verticals, but the numbers are still quite healthy, so we scored this an 8 out of 10. Finally, Microsoft's operating income growth rate has averaged 40% over the past 5 years, which is strong, but not as significant as some other organizations in the tech sector, so we've scored this a 7 out of 10. This gives Microsoft an overall fundamental analysis score of 8 out of 10. Looking at Apple's fundamentals now. Apple's operating and net margins have been decreasing slightly over the past 5 years. However, the numbers have been consistently over 20% in the last 10 years, which again indicates a wide economic moat. Their Q2 margins are up on last year's numbers, so we've scored this a 9 out of 10. For return on asset, Apple have achieved a double-digit ROA consistently over the past 10 years, which is outstanding, so we've scored this a 10 out of 10. And for ROCE, they have consistently achieved a level above 15% for the past 10 years, so again, we've scored this a 10 out of 10. Moving on to debt to equity, Apple's debt to equity has been increasing annually over the past 5 years, which we would need to pay close attention to if we were to invest in this stock. What's slightly concerning is the Q2 increase, and we'd need to monitor this in the next round of quarterly results. So with this in mind, we've scored debt to equity a 4 out of 10. Moving on to Apple's PEG ratio. Apple have had a negative PEG in 2 out of the past 5 years, and this is related to the negative growth they experienced in these years. This suggests that the stock may be overpriced, so we've scored this a 4 out of 10. Moving on to Apple's free cash flow yield. Apple's free cash flow yield has been above 5% for the past 10 years, which is outstanding. However, it is gradually reducing, and it's for this reason that we scored them a 9 out of 10 instead of full marks. Finally, Apple's operating income growth rate has averaged 9% over the past 5 years, which is on the lower end of the spectrum when compared to other tech stocks. They also experienced negative growth last year, and there's a risk that this could be repeated this year, so we've scored this a 5 out of 10. Positive note to mention here is that their Q4 revenues could see a boost with the launch of their 5G iPhone 12, which is due to be released in the next few months. This gives Apple an overall fundamental analysis score of 7 out of 10. We'll now compare Microsoft and Apple against Amazon, Google, and 2 sector ETFs. Looking first at net margin, both companies have great margins that are consistent, so we've scored them both 9 out of 10. Moving on to price to earnings ratio, both companies have similar PE ratios in the mid to late 30s. However, when we compare it to Google and the ETFs, you can see that it's on the higher end of that scale, so we've scored them both a 7 out of 10. Looking at the PEG ratio, Microsoft's PEG is in the same range as Google's, so we've scored them a 7 out of 10, whilst Apple currently have a negative PEG, so we've scored them a 4 out of 10. Looking next at the dividend yield, now both companies do pay a dividend, and both yields are above the ETF sector average. Apple have a slightly higher dividend yield than Microsoft, so we've scored them an 8 out of 10 and Microsoft a 6 out of 10 for dividend yield. Moving on to current ratio, Microsoft has a good current ratio of 2.52, so we scored them an 8 out of 10. In contrast, Apple has a current ratio less than 1. And this is a concern, particularly when you compare it to the other big tech stocks who all have current ratios above 1. So for this reason, we've scored Apple a 1 out of 10 for current ratio comparison. Moving on to the cash ratio. The cash ratio is the ratio of cash and cash equivalents to current liabilities. The higher the number, the better. We'd like to see a value greater than 0.5 for a tech stock, but what's surprising here is that Microsoft's cash ratio is 0.16, which is very low, particularly when compared to its peers. When we take a closer look at Microsoft's cash flow statements, we notice that its cash performance has been relatively weak, so we've scored them a 2 out of 10 in this area. Apple are just off the 0.5 mark, so we scored them a 6 out of 10 for cash ratio. For return on capital employed, as covered earlier, we score Microsoft an 8 and Apple a 10 out of 10. And for price to book ratio, Microsoft has the lowest price to book ratio amongst its peers and also lower than the sector ETFs. So we scored them a 9 out of 10 in this area. Apple's is almost as high as Amazon's, so we've scored them a 3 out of 10. In terms of debt to equity, both companies have a debt to equity ratio greater than 1. So we scored Microsoft a 5 out of 10 and Apple a 4 out of 10. And finally, looking at the 12-month share price difference, both Microsoft and Apple's price increase has been slightly less than the sector ETFs. So we scored Microsoft a 7 out of 10 and Apple an 8 out of 10 here. This gives Microsoft a comparison score of 7 out of 10 and Apple a score of 6 out of 10. The final step in our analysis is to determine the intrinsic value of the stock. At the investment store, we use a discounted cash flow method and Gordon growth model to estimate the value of an investment based on a company's future cash flows. Using an annual growth rate of 20%, we calculate an intrinsic share price value for Microsoft of $202 per share. Now, this isn't far from their current share price, which at the time of recording this video was $211. Now, using Microsoft's 5-year average growth rate of 27%, we calculate an intrinsic value of $351. Now, we believe if Microsoft continues to acquire market-penetrating businesses, this growth rate may be achievable. So with this in mind, we score Microsoft an intrinsic value score of 8 out of 10. Apple recently had a 4-for-1 stock split, which means they've increased the number of shares by a factor of 4. Using an annual growth rate of 12%, we calculate an intrinsic value per share of $84. Apple's current share price is approximately $125 per share. And for this value to be justified, Apple would need an annual growth rate of 17%. Using Apple's 5-year growth average, which is 8.5%, we actually calculate an intrinsic value of $64 per share, which is almost 50% of the current share price. This clearly indicates that Apple, in our opinion, is overvalued. So we give Apple an intrinsic value score of 3 out of 10. So in summary, we have recorded the following scores for Microsoft and Apple, giving Microsoft a score of 8 out of 10 and Apple a score of 6 out of 10. Now at the investment store, our goal is to find great companies for a low price. These are indeed 2 excellent companies, but the share price, particularly in the case of Apple, offers little margin of safety and is higher than we would like to pay. If we held stock in Apple, we would actually consider whether now would be a good time to look at our cash position and to sell some of the shares in this stock. We would also pay close attention to the growth rate of both companies to see whether they're achievable. In this case, we believe that the Microsoft growth rate is achievable, but the Apple growth rate is questionable. A question for you. What growth rate would you apply to these businesses and why? Please leave your response in the comments below. Thanks for watching. If you enjoyed this video, please leave a like and let us know what you think of our findings. If you'd like to learn more about how we analyse assets, then please subscribe to the channel. We look forward to seeing you on the next video.